Highlight for the session just brought to my attention that kind of a textbook trade. Dave mentioned two big sellers that are indicative of these red boxes, and then coupled with passive resting bidders or buyers looking to buy above average size, as shown in the gray lines. Gray lines below are passive resting orders on the buy side. These are aggressive sell orders. And order flow 101, 102, 103 is selling should make it go down. Selling should make it go down, and it doesn't. And so it often, if it doesn't get you long, maybe it could keep you from reaching and getting short. If you're short, it could highlight the price to get out, but that's using order flow to qualify or disqualify price. And people talk about order flow all the time, and most don't learn it the right way. They don't put themselves in front of the important orders to watch, the questions that they're going to allow you to ask. Now, the highlight that I wanted to go over before that was that just surfaced just now was about 15 minutes after today's open. We had a couple things that happened price pattern wise or chart pattern wise. Let me open up an ES chart and take us back to about 8:45 this morning after the markets open. We had a pretty balanced poll. Everybody was like 1/3, 1/3, 1/3, bullish, bearish, neutral. All right, which makes sense. We were opening up unchanged at around 8:30 Central. And so a couple things happened to call the upside. And let me open this up so you can see it better. And now it wasn't a couple things with today. We had light volume coming in. We mentioned that. It's like the traffic was light coming in. So you have to meet your expectations. You're not looking for a 10, 20 point move. This is a great move from here to here. From here to here is actually a good move. Certainly from here to here. Here's a rotation, and then they crack it. That's a good move. So you're maybe 3-4 points is an excellent move on a session that has light volume coming in, and it's kind of just waiting for news. But without getting too macro on you, here's something that's important: a long down up bar that you see. Now that in and of itself isn't going to get you long, and you're going to just say we all the way up to 71, 72, which was this rally that started around 8:45. However, it could be another important piece or circle of skill you have to try to find order flow, correlations, the overlap to increase the probability of the trade working. We talk about price patterns. We talk about long down up bars in this case, which means you get one bar that goes down on a point and figure. The very next bar takes away all the weakness, and that's a transitional moment. Why? Well, number one, when you go down all the way like this in one bar, you get people that are bearish. Why? Because most people think, and don't take offense to this, most people think like fifth graders. And they're like, oh, it went down. So they try to sell it, sell it, sell it, sell it, sell it on an uptick. And that might be fine. What isn't fine is realizing that this entire bar lower in one bar got retraced. So the thought process is long down bar, long up bar, is that you got some stuck shorts in the market just based on how far this rallied in the very next bar. Stuck shorts are generally a very good indication of a transition from down to up, because stuck shorts, people who get short and take immediate heat, are buyers. When you're short, you're a buyer. When you're a stuck short, you're a angry, anxious buyer. You look like this, your eyes are a little dilated. You're not happy. You're sad, and you're about to get cut. And so that's part of this transition that you could see inside the chart. Again, in and of itself, isn't going to make you $1 million. Isn't going to get you to get on that rally. However, there was some other tells in there based on some longs that had puked on the way up, which is what you want, less longs in the market. And you can't see it on this chart. It was another chart that you've seen some longs puke at some point on this rally, which is what you need. But also, and we've been talking about this a lot, the cousin to the S&P, the NASDAQ. Scroll back to 845 Central, and you want to see if you're long, if you're looking for an upside transition in the market that you trade, in this case, the ES, you're looking for the NASDAQ to do something that's bullish or to confirm your trade or to go up, right? So this is the NASDAQ. Look at the way you're supposed to look at charts is create visible boxes. The middle of the box is important. The bottom of the box is important. The top of the box is important. And now let me just walk you through this. At the same time, they leak out the bottom of the box right there. They go here. At this moment in time, we don't know if it's going to continue. We don't know if it's going to come back and then continue. What we do know is if it doesn't and it jumps back quickly into this box, there, that's a head fake. And a head fake is, hey, we're going down. No, we're not. Another transitional moment and a pattern, only in a different market. The middle is important because once it gets through the middle, it usually gets fast to the other side. Why? Because you got momentum shorts that are pissed because they immediately take heat. You got longs that were long inside this box that probably got shook out and stopped out, and they're pissed because they get stopped out of a long and then it goes up. And so they might be trying to chase. But either way, if you have longs that got stopped out, you have less longs, you have less selling. Less selling equals an easier chance to go up in the price of anything. When you got momentum shorts, and we'll call it more shorts, MS equals more buying. That's what you are when you're a short. You're a buyer. And so if it immediately comes out in the middle of this, no coincidence, it gets fast and takes out the top. That's why the top is important. And you could see this bar right in here. If I blew it up, you could see it better. Went up and went up pretty fast. So the whole point of what we're trying to do here is find the correlation, which is a skill set, order flow, which is a skill set, transitional price patterns, which is a skill set. You don't need or want 10 circles. You'll never trade. But you're trying to find not just a few circles, 2 circles, but more than one. But the important thing is that the circle has to be a concept that matters in valuing price. All right. If moving averages and stochastics and relative strength and Fibonacci is your deal, I'm not going to argue with you. That might be helpful. That could be a circle, but you certainly don't take a Fibonacci chart into a car dealership to negotiate price and find value. If you do, it'd be funny to videotape that. So think of what you use to value price when you buy plane tickets and houses and cars and anything with a price attached to it. Think of the technique you use. And if you're not applying it to valuing the price of the S&P or crude oil or a stock, then you're ignoring what we've used as consumers to value price since it was invented. Price, that is. So find your circles, get better at each one of them, which is order flow, correlations, the patterns that matter, and know why a pattern's important. So you're not married to a chart. You don't need to be married to a chart. You need just to be alerted. So if the chart, the best indicator would be if a hand came out and slapped you in the face to tell you like what we just walked through. 2 transitional patterns from down to up in the ES and the NASDAQ, and then a shakeout on our puke tool that there was less longs in the boat. Have a safe rest of the day. See you on YouTube. Subscribe, notify yourself, do all that, all those good things so we could go live. And then once we go live, look out.